In this final video on ratio analysis, let's continue to talk about the different types of analysis we can make. Now, one of the things that we can create from financial statements are things called common size statements. A common size statement, we talked about income, everything is divided by sales. We can also do the same kind of strategy with a balance sheet. In this case, we're going to divide all of the line items in the balance sheet by total assets. So as a proportion of assets, what is the proportion of this item? Or how does it relate to assets? So we can see here across the board, there's been a decline in cash equivalents. In 2017, 23% of its total assets were cash. In 2021, it's 13.3%. Why the decline? We might want to be interested in knowing that number. Total current assets have declined as well. Well, what declined? Well, it really wasn't any of the other current assets, although there was some decline in these. The biggest decline in time has come from cash and cash equivalents. What's going on there? We can see that in general, assets were growing pretty good in 19 and 20, but now there was a huge decrease in 2021. What caused that? Right? We obviously had something happen. Either the asset base grew or the plant and equipment asset declined. Again, the nice thing is we can see how things are related, right? How are management's decision affecting the statements? This is a little bit more difficult to use, but it's the other side of the equation. And again, everything here is divided by total liabilities and shareholder equity. But we can see here, we see that accounts payable, in this last year, 15% of the debt of the company, of the financing of the company, was accounts payable. Long-term debt, it's down here somewhere in the middle. Long-term debt is 40% of all the financing has come from long-term debt. And here's that number we talked about earlier, the debt ratio, which is total debt divided by total assets. 73% of all the financing comes from some form of debt. So again, nice information that we can look at how things, how management's decisions are affecting the line items specifically. Another form of analysis is something called a percent change statement. This looks at how have the line items changed over time. You can see that from 17 to 18, there was a 10% decline in profits. 18 to 19, profits went up 17%. Then they went down 11, then they're up 17. So sales seem at least to be a little unstable, right? What about net profit margin? You see from 17, you said something weird happened in 17. So we had a huge increase in sales. But after that, again, we see 38%, down 13%, up 26%. So the numbers historically seem to be a little unstable. We may want to investigate that a little bit. We can do the exact same thing with the balance sheet. This just looks at the total asset section, right? But we can see the what? Total current assets from last year to this year are up 17%. So we've increased this fairly significantly, right? Net property equipment, we already said we know there's a decline. It's down 8%. Again, why do we want to understand this? It gives us a picture of how management's decisions are affecting the line items and the things that we've purchased for the company. So a last set of ratios to look at are what are referred to as market ratios. These are relationships between the stock price of the company and another ratio or another line item. So in this case, we have the PE ratio. This is the market price divided by earnings per share. Now, this talks about the amount investors are willing to pay for each dollar of a firm's earnings, right? It's kind of a break-even number, right? If the PE ratio is 50, essentially means you're willing to pay $50 for every $1 of earnings, which means how do you get your money back? You get your money back through earnings. So earnings, you'd have to get $1 a year for 50 years to cover the original cost of that asset. So again, the bigger the number, the more indicate that maybe this asset might be overpriced, that the stock price is too high. In addition, we have something called the market to book value ratio. So the first thing we need to know is what is the book value per share? It's just the amount of equity, common stock equity, divided by the number of shares. The market to book value ratio then is just the market price divided by the book value per share. This again gives us an assessment of how investors view the firm's performance. The higher the number, the greater the market price is reflective on investors are optimistic about the company's future, right? So here's a picture of the PE ratio for Coca-Cola, and we can see that it's a little bit bouncy around, right? A little bit changes from year to year, but in general, we see it's an upward slope. So investors appear to be pretty optimistic, and their optimism is growing of Coca-Cola over the past 4 or 5 years. In addition, if we look at the market to book value ratio, again, a good indicator, right? A good marker is a minimum of 1. You don't want this number to be less than 1. Less than 1 indicates that the company might be taken over by another company. Again, it's a little bit beyond this course, but we can see that there are some pretty, last couple of years, there have been some pretty jagged changes, right? So it looks like there's been some changes in valuation, but in general, we have an upward slope that indicates that in general, investors are optimistic about this company's growth. So again, how do we analyze these, right? How the PE ratio tells us how much they're willing to pay for $1 of earnings. Investors, the market to book ratio tells us how much they're willing to pay for $1 of book value. So again, for each number, the higher the number, the better. And of course, if a company has a lot of expected growth, right? I mean, investors like that, right? They're optimistic about that. Then the number is going to be higher, right? And the risk is lower. So again, if the number gets higher, again, it's an indication of what shareholders are optimistic. Now, we do have to worry about them getting too big, because if they get too big, it could be we are over optimistic. That might mean that the stock price is overvalued. And for an investments course or a portfolio course in maybe portfolio management, that analysis is something that we talk about to a great degree. Is that are investors paying too much? That's an investment question, not a corporate finance question. So again, thanks for watching the video. I look forward to seeing you soon.